And what a rally for commodity prices overnight. They surge, and really there's no market more heavily dominated by commodity stocks in Australia. And let's get to our first guest right off the block. And Nick Burmester, who is the MF Global Australia's head of hedge fund sales, joins us this morning from Sydney. Nick, let's talk about this surge in oil prices. What a rally. Do you think they'll continue, though?
Look, we are a big fan of oil as a commodity longer term, Susan. We do expect a little bit of a pullback due to, OPEC not really changing their policy and, just a bit of an oversupply short term in terms of inventories there in the US. Longer term, we are very bullish on oil and energy in general. We think that, global demand for energy in general will be up by 50% over the next 20 years. So as a result, we are bullish on anything connected to energy, and that includes oil, gas, particularly LNG, and thermal coal. So, whilst a short-term pullback may occur, we would use that as a buying opportunity in some of the stocks that are exposed to the energy space.
Okay, Nick. Now I'm going to bring in our energy reporter, Christian Smallinger, now, who joins us from the Singapore newsroom to get more on these oil prices. But we'll get right back to you, Nick. Shmuley, let's quickly check in on crude
Susan.
prices right now, and let's see how they're trading at this point. If we can bring up that graphic. Otherwise, we'll get that to you later on. But let's talk about the price of crude, Shmuley. I mean, why are crude prices continuing to rise with the weaker U.S. dollar? That seems to be the big factor these days.
Yeah, it's very closely linked right now. What we're seeing is a lot of people looking towards commodities to really hedge the inflation risk that we're seeing. We've seen the dollar really come off quite a bit. If you look at the dollar index, kind of the measure of the dollar versus about 6 major currencies, we've seen that's fallen down to 77 today. It's come off about 11% since April. So what we've seen is probably a lot of fund buying coming in, buying oil, buying commodities to really offset that inflation risk that we're seeing.
Yeah, well, despite the bullishness that we're seeing in the energy markets, Goldman Sachs, the world's biggest brokerage, and a lot of people listen to Goldman Sachs, they are sticking to its $85 call for oil by the end of this year. Do you think that's still going to be possible?
Yeah, well, it was interesting. What the report was really looking at is how a lot of companies in the U.S., a lot of major manufacturers, they've been destocking their inventories. So what they're looking at is as these inventories destock, these manufacturers are going to start shipping more goods to make up for the inventory that's lost. And that's going to be really good for distillate demand at a time when distillate demand traditionally increases during the fourth quarter, when you start to get a lot of heating oil demand. Over the last year, even despite the recession that we entered into, we still saw heating oil demand rise about 6% last year. And in 2007, it was up 9.6%. So I think a confluence of those factors with the heating demand and the distillate demand for diesel to move goods, you're going to see prices climb, or at least that's what Goldman's supposing.
Yeah, Shmuley, with the oil prices on the rise, do you think OPEC might be motivated to either increase or decrease cut supply?
Well, I think at this point, all signs are definitely pointing to no change at the OPEC meeting tomorrow, or tonight, actually. We had Ali Naimi came into Vienna yesterday saying that he felt the oil market was in good shape, or it was his words. I think OPEC has to be pretty pleased with the prices that they've maintained. We've seen oil come up 60% this year, and it's very close to that $75 level that they've been calling for some time. So I don't think they really want to rock the boat. And given that we are entering what is traditionally the highest demand period for the global oil market, leaving crude supplies unchanged is probably only going to lead prices go higher.
Okay, Shmuley, thank you for checking in. That's our oil reporter in Singapore. Now let's get back to our guest this morning and bring back in Nick Burmester, who is at MF Global Australia, and he heads up the hedge fund sales at the brokerage. And Nick, you heard from our Christian Smallinger, and he says that there seems to be a lot of bullish calls on the price of oil. So what does that mean for oil stocks then? Is this the right time to get in?
Yes, well, we've identified LNG as the main opportunity in the energy space. LNG prices are linked to the oil price. The reason we like LNG, Susan, is that gas's share of energy demand is set to double. So if you've got general energy demand up 50% over the next 20 years, then gas by implication and LNG being the global market for gas should more than double in terms of the demand for gas over that period. And so the stocks we like in that space, the large cap stock we like is a company called Santos.
Oh, we've heard of Santos, Nick. Let's talk about Santos then, shall we? Because Santos stock, is a laggard play so far. If you look at it, it's 11% gain compared to the ASX's 21% gain so far. But what are the good levels to get into this stock at?
Well, technically, the stock did a lot of work sort of trying to push through the $15 a share mark, and it has sort of pushed through that area recently. We do, given we expect a little bit of softness in energy and some profit taking, I'd be looking to enter the trade around the $15 area. There are some catalysts coming up, in particular, where we think Santos shares could have some further upside from in the short term.
How much further upside? I guess you're expecting a stake sale coming up soon to maybe a Dubai fund.
Yeah, well, Oil Search, one of Santos's growth projects is in the Papua New Guinea gas project. Now, Oil Search are the operator up there, and they are due to announce a sale of 3% of their interest in the project to a group called IPIC, which is a Dubai investment fund. Now, IPIC own about 18% of Oil Search via a convertible, so we expect the price that stake sold at by Oil Search to be quite high, and Santos in turn have about half the interest that Oil Search do in the same project, and they should get an uplift if the price is good. Oil Search has been outperforming Santos of late, so we do expect Santos to catch up on that news if in fact it is as positive as we think.
Yeah, and how much do you think that might add to its share price? It's currently trading at $15, but let's say this deal does go through. I mean, how much higher do you think the stock will shoot up?
Well, there's a couple of things there. The stake itself, is probably, in terms of Santos's valuation, might account. You might get about 5% upside as a result of that announcement. The reason we like Santos, I guess, more than that is that we've marked to market its growth assets by using the Oil Search share price as a proxy for that PNG growth project. We use Eastern Star Gas's share price and a multiplier for Santos's acreage in the Gunnedah Basin in Eastern Australia. That's coal seam gas. And we use about 70 cents a gigajoule of 3P for the Queensland coal seam gas, where you've seen massive investment by offshore players to prove up reserves for LNG. And if you do all that and add back the cash, you're left with a producing and exploration business on about 3 times EBITDA, and that would account for a small part of Santos's current valuation, probably about 20% at the moment, and we'd expect that to double as the market really gives value for that producing business.
Those are big numbers that you're talking about, but right now we'll get back into Santos and talk about your other energy picks as well after this break. So we'll have more with Nick afterwards. Of course, in the meantime, you can send in your questions, asiaedge@bloomberg.net, and we'll see you after this. Let's talk to someone and bring back in our guest, Nick Burmester, who sells to hedge funds. He is at MF Global Australia as a head of hedge fund sales. And Nick, are you seeing recovery in terms of demand from hedge funds? Is it easier to sell it, or is there still a lot of money still sitting on the sidelines?
Yes, we've seen a big pickup in our business, Susan, and just speaking to our prime broking department this morning, we are seeing lots of demand for financing, stock loan and execution from particularly local trading pods and hedge funds, also from some offshore players looking to diversify away. But the biggest service that we're seeing demand for is capital introduction, which is introducing local hedge funds mainly for us to capital. A lot of the big superannuation funds down here, or the pension funds, and some of the family private money that's out there is looking to allocate to this space, given Aussie hedge funds significantly outperformed, global hedge funds and markets in the 12 months to June. And you have seen quite a big pickup in returns over the last few months, with everyone mainly playing the recapitalisation stories, and selling out for a profit. So we are seeing big demand, and most of our clients trading fairly regularly.
And Nick, what is a strategy that MF Global Australia is advising for its clients, especially its hedge fund clients? Because MF Global does hold this view that maybe there might be a bust in the market at the end of this year. So is it time to short?
Yeah, we have a chief economist who is from the Austrian School of Economics. So he looks at, his name's Dr. Frank Shostak, and he looks at money supply and the amount of money that central banks in particular and governments are pumping into the global economy. His view is that is the driver of the economic cycle, and that generally, if you have a big period of money pumping into the world, that will follow with a period of a slump or a correction in the market. In the meantime, commodities certainly benefit due to that inflation theme, I guess. China's continuing to pump money, driving commodities. So what we're saying is stay long commodities, gold, but make sure you take your profits if they're there, and probably buy some cheap protection. Volatility is quite cheap out there, so buy some December put options over the market to protect that portfolio while you trade the current market, which is remaining positive. We do expect a correction globally, particularly in the US at the end of the year. However, Australia should do better than most, given the China theme and the improving local economy.
Playing on this commodity theme still, and another stock that you recommend and that you like is Boart Longyear. This is the world's biggest provider of drilling services, also listed in Australia. Now its shares have gained about 70% a year to date, but I was looking on the Bloomberg in terms of its PE, and they are out of this world. I was looking at maybe just to current year, and I'm looking at maybe huge PE ratios for Boart, and also the other next stock pick that you have coming up. But I also want to talk to you about its debt ratio as well. 386% of debt equity. Isn't that a concern for you, for Boart?
Yeah, but there's been a big event, recently where Boart have raised circa $700 million to pay down most of their debt. Now that event's ongoing at the moment. They have raised about half that money, with half to come later this month. After the raising, it's almost like an IPO. They'll go from the debt ratio you mentioned to a debt to equity of about 15 to 20%. And they have also given a forecast for 2010, which makes them look very cheap to us on an EV/EBITDA basis. Okay,
Nick, I'm going to try this really quickly. Let's quickly talk about Aquila, because this is the stock that I said had huge PE ratios, or at least a price to target, 123% for this year, 400 times PE next year.
Yeah, Aquila is an asset play to us. It's got a beautiful suite of assets that go into steel production, being iron ore in the Pilbara, high-quality coking coal in Queensland, and some manganese, all used in steel production.
Nick, it didn't work out. We ran out of time, unfortunately. Sorry about that. Nick Burmeister of MF Global